My name is Chris Rugaber, and I cover the Federal Reserve and the economy for the Associated Press in Washington.
Highs and wage growth elevated. Job gains have been robust. At today's meeting, the committee raised the target range for the federal funds rate by 3.
Well, today the Fed raised its benchmark interest rate by another hefty amount, a 3/4 percentage point increase. And Fed Chair Jerome Powell, I think, really sought in his press conference today to drive home how serious the Fed is about raising rates to fight inflation. And even if it does cause some higher unemployment or some trouble for the economy, the Fed has lifted its benchmark interest rate to the highest level since 2008. Between 3% and 3.25%. And that should push up borrowing costs, or it will push up borrowing costs for things like mortgages, auto loans, business loans. And the Fed hopes that by raising the cost of borrowing, it will slow spending and therefore slow the economy a bit, and then that will bring down inflation.
2025, still above the median estimate of its longer run value. Projection in the SEP for the unemployment rate rises to 4.4% at the end of next year.
Well, one of the other things the Fed did is it also projected that it will continue to hike rates even to higher levels than previously expected. So it now expects to push its key benchmark interest rate up to 4.5% by the end of this year, and another 1/4 point after that. That should push up the cost of mortgages and other borrowing even higher. We've already seen the housing market take a hit. Home sales have fallen 20% in the past year. The 30-year mortgage rate has topped 6% for the first time since 2008. So that is going to make it harder for folks to buy a home. And it also risks a recession. So there is a risk that a lot of people will lose their jobs, frankly. That the Fed has increased its forecast for how high unemployment will go. They now expect unemployment to get up to 4.4% next year, and that's compared to 3.7% now. And that translates really into about 1 million people, potentially 1.5 million, losing their jobs. So that is probably the biggest change that's on the horizon, at least for those who will be unfortunate enough to lose work. But for other people, there will be higher borrowing costs on things like credit cards, mortgages, and auto loans. It was expected that they would do a lot of what they did. So, right, the big rate hike was expected, and it was expected they would project higher increases into the future, but they did project a little higher than many people thought. So it was a bit of a tougher set of measures than were expected. So the stock market has gone down some, and the bond market has also taken a hit. So there was that negative reaction. But it's in the same direction that people expected.